Hi, Warriors, TGIF. How's everyone doing? AJ, all you guys that wish me a good morning every day. It's really nice.
Good early morning, Dale. TGIF.
TGIF, my friend, and NFP day. So, just looking at the week.
Twitter reports the expiration of
Oh, I hear somebody. Anyway, metals had a great week.
Yeah.
I know gold's giving some back here, but pretty good week, unless we're going to fail here and break one more time.
Grega called it spot on earlier in the week. Grega, he bought in the 1830s and then or initially this 70.75, and that's exactly where we stopped. So
did he take profits on the pattern in play?
I think he extended it actually. I'm not sure. I think he's looking more for 1900 right now.
Yeah. Okay.
Oh, he's even put the target higher. Okay, but
okay. So to me, this is a big area. Okay, it was held this low once we had a breakdown.
Important.
Around 1888. Back here I was embracing. We could go to 1680. But, like W.D. Gant says, if you don't learn how to change your mind, you won't have any change left. And since silver hit its target by cleaning out all the buy stops under 2140, I went with it. So, this is very important. Then this trend line comes in at 1920. Maybe that's why he had 1920.
Look at it too, that one, yeah.
That'll be a breakout.
Yeah, and then look at from March, April, that traffic zone there in gold, yeah, from the 14th of March until this is a really traffic zone in these 1920s and stuff.
Yeah,
gonna be important there. Probably before 2000, if it gives way.
Yeah, well, I think that stay out, don't walk in traffic, because I think it's going to run you over. And as long as we hold 1780, the bull case to me is alive and well, especially last 3 weeks, all blue candles, lots of reversals, 2-week reversals. Even though we're down today, it hasn't done anything wrong. Silver looks even better. The gold silver ratio is putting in a real ugly week, and if we start closing under 82, that's even more confirmation of a bull market in metals, silver being the preferred long. And I think that's going to happen with an energy top. So I know we're still higher on the week, and I know it's unpopular, and we could still probe 120 again because we did confirm. But I don't know. I just keep looking at what a crowded trade it is, and no one wants to talk about the bear side, and it's possible. So, I don't know what would do it.
The reaction after OPEC yesterday, market was disappointed about the increase that they are planning.
Look what they held.
Yeah. And then at
112 right there. Yeah.
And then at the same time, you were saying that their stockpiles are still coming off.
There's nothing bearish. There's no bearish news about energy.
That's it. So I'm a little afraid. And about silver and the correlation, it's interesting that you talk about it. But I was also looking at silver over the flow show this morning, and we look at the period, the time span that silver came off. It's exactly the time where China went into the lockdowns, and April, May. China put in the lockdowns again. That's where silver came off. Since it's like such an industrial metal, right? And then as soon as China started to talk about possible openings again, silver found the bottom mid to late May, and then started to rally again.
Mm-hmm.
So I think we need to keep a close eye on all those reopenings, and if they continue in a good way, I think silver can really outperform gold as well.
Yeah, actually, our guest today, Michael Green, he said he's skeptical about China reopenings.
Yeah.
He said they can't reopen. So
Yeah.
he's been on CNBC. I checked out his Twitter stream, and he's got some interesting things to talk about. I'm going to bring that up.
There's a lot of moving parts still in those reopenings and the economic data.
Yen still looks good.
Yeah,
I mean, it's a pretty good week. I don't know why it would stop without making a new high anyway.
Well, a bad U.S. labor report could turn things around, but it's one of my favorite rockets. If the report would against expectations, if the report would beat, this thing could be at 131 straight away, right? The dollar yen, because yields are going to push higher. And
yeah, but the yield chart doesn't have the same energy as yen. But go ahead, Blake.
No, I was going to say, hey, good morning, guys. How are you,
buddy? Good.
You know, I just wanted to mention about. Hey, I just want to mention about the dollar. The F.A.C.E show. It is the dollar yen. You know, I just got out of mine, Kman. I've been playing it to the long side the last 24 hours. I bought it and sold it twice. But I think today is going to be a little tricky, and I wanted to get your thoughts regarding this data. And you know, we are in that mode. The market is that good data is not good for risk. Bad data is good for risk, right? Yeah. Like the market wants to see softer employment right now. Yeah. So what happens?
Off the Fed.
Yeah. So like, let's think about that really quick. And let's just talk about the dollar yen, because it's been on my radar too. I think it looks bullish, Kman, and I'm with you. And I think, you know, a strong jobs report could push it to 131 pretty quick.
Yeah.
But is it going to hold? Like, you know, like let's say that, you know, you get a strong jobs report. The first, you know, knee-jerk reaction from the market's going to be, ooh, you know, strong jobs report, stocks go up, and then you know how it is, and then everybody sits on it for a second and says, well,
what's the expectation, buddy? For
well, around 300K.
Around 300K. But let's say we come out. I mean, I don't like betting against the, you know, the U.S. labor force right now, because, you know, it's still pretty hot, but, you know, people are hoping it just cools down a little bit. And if it does, and like, let's say we come in with a number, like, let's say 200,000 or 180,000, something like that, the market's going to go, yeah, that's exactly what we want. You know, we want that data to come down, or we want it to come down. So the Fed would be more dovish, you know, moving forward, and they can see the cracks in the surface of the labor force. And that one to me is easy. That one to me would be, ooh, dollar yen comes off and we see a move back to 129.50 in the dollar yen. Then I could buy it, because then I'd think, okay, risk appetite is going to be strong. And we could probably sell some yen on that type of move. But on a strong data point, and let's say we come in at 450, 500,000 jobs, and let's just imagine the rest of the wage data is, you know, complementary to the headline data, because it gets a little bit more complicated than that. However, data is good. It's nice and strong. Dollar yen spikes up to 131. Do you actually sell it, Kman? Because people might go, shoot, that number's way too strong. The Fed's going to be super hawkish. They're not going to let off they're not going to, you know, let go of the stranglehold they have on the market right now with their rhetoric and raising rates. Maybe they'll even be more aggressive. Then the dollar yen, you know, how does it react? And I don't know. And that's why I want to ask you. So what do you think?
Okay. Well, what I think is what I put in the room as well. I think assuming that we have a strong report, the market is now trying to price in, and that's why stocks are also partially holding up. But there's another reason why. The market is now trying to price a pause somewhere in September, October in the US hiking cycle, right? They see two times 50 VPs, and then thinking that the Fed will go to 25 or even later in the year stop it. But if we get a really good report today, I think the market is going to price part of that pause out, because Brainerd and I don't know who else yesterday, they were still hawkish. And let's face it, Powell said, yes, there might be some pain, but we are ready to suffer that kind of pain. So if the report is really good, that means no pain yet, between brackets, then the market should or can price out this pause. Yes, it will be initially a bit bad for stocks because the yields should climb higher. But I think dollar yen, I can't buy yen right now because Bank of Japan is telling me that they will still be slow and they still expect the inflation to cap at their 2%. I really thought that they would start to change something, but they still don't show a real will of taking the foot of the easing pedal. So in my opinion, a very good report will see dollar yen shoot. I'm still on Canada yen. I like that one after the Bank of Canada and Baudry. So I'm not in the dollar yen right now, but if the report is really good, I can see dollar yen go to new highs.
Yeah, I'm sorry, Dale. I just robbed the charts from you real quick. And here's the dollar yen. I see it as, first of all, it's flag pattern after flag pattern, and it's not pretty if you're shorting dollar yen right now. I just want to say that because, from a long-term perspective, if you look at the blue flag pattern, this is like, and here I'll just draw the flag stick, or I'll just take this flag stick right here and go like that. The extensions that you see here, and you could just even take this one just to start, it hasn't not played out yet. It hasn't negated itself. It had to get below 126 to do so. And that points to 135 and change. You got this little one that's intraday that's playing out right now, the 132.86, and all of it points well above 131.50. I mean, so technically it's got all the genetic makeup, like flag inside flag of, holy cow, man, if this thing breaks out, it could really break out. And so that's the one thing I want to make sure that everybody is really clear on here is technically everything does look very bullish for the dollar yen. And it's hard to stand in front of it. And when we broke above this 128, 75 level this week, I've just been playing it on the long side. I mean, the dollar yen's, clearly trying to make its way higher, but today is obviously the interesting part, and or the interesting data, because it's going to be, the reaction, to this data. Now let's see if we get any other reaction from or feedback from Stelios, because Dale, you mentioned just a moment ago that about silver is going to outperform gold, or did you say that, Kman? I can't remember.
I did.
You did? Oh, that must have made Stelios just absolutely squirm in his pants. So Stelios, he fainted, he squealed a little bit. I heard him
anything because every time you make fun of me.
All right. So what's up, Stel? What do you feel about today, man?
Well, about the data, I think I said this yesterday. I think chances are that we're going to get disappointed, but in terms of, I think we're probably going to get a little bit lower than expected. But that's not the point. The point is, what do we do with it?
What are labor costs? Is that going to be more important?
Average hourly earnings, you mean? Yeah, average hourly earnings. Yeah.
Let's talk about if we get a weaker data point, as you point out. See, this to me is like an easy trade, because I think that if we get weaker data, I can't even speak this morning. It's Friday. If we get weaker data, I mean, look at the euro. It's nudged right up against this, long-term trend line. I mean, it's risk on, sell dollars, buy euros, or buy something else, right? I mean, and the euro is just ready to, the euro is poised and ready to go. Right.
It is, and it's 1081 really, which is the level. But you're absolutely right. We're at that trend line. If we do get weak data, I think the euro is the one to play. If we do get strong data, I think selling stocks is the way to do it, because exactly for the reason that you said before. I'm not going to repeat it, but I think we're probably going to get something like 250K. It's going to disappoint the market slightly, and I think it might be a nice little reason for the euro to push a little bit higher.
All right. Well, I was going to say, is this a situation where it's kind of like the Oh, what is the wool? No, wait, when the porridge, you know, you don't want the porridge too hot. You don't want it too cold. You want it just right.
I've never had porridge.
Me neither. I don't. What is porridge? It's called
I don't
Goldilocks. That's what it is. What is porridge? What is porridge? I like. You know, is it like slop? Is it like grits? Have you ever had grits?
No.
Yeah, it's not pleasurable. No. Anyway. Okay. So.
So
anyway,
to answer your questions about metals, though,
let's talk about your metals.
I think that silver is eventually going to outperform quite strongly. So I think the gold-silver ratio is going to drop probably towards
40?
the 60. Well, 60s. I think it's somewhere. Let me have a look. Hold on.
And just FYI, this is the silver inverted head and shoulder pattern, still not negated. Now, I don't know if I'm really looking at it like that. Oops, shoot, I didn't want to do that. Hold on.
Yeah,
change that. I don't know if I really want to look at it like that right now, but you know, you could actually look at it more as a, you know, bear flag pattern currently. But I think you can look at it a couple of different ways. So anyway. But what do you think?
I do think the gold silver ratio is going to go and test those lows 62.5. What was it in 2021? Which should coincide with broader strength of metals in general. Now, the problem will be if we get yields spiking higher, which I think we will at some point, and that always brings downward pressure to metals, at least in the short term. So with yields driving higher, I think 10-year US is going to drive above 320, is going to test those highs and go above. You know, how much further, I don't know. But as long as the Fed don't change course for the next, say, 2 or 3 months, then I think yields are bound to go higher. You know, I've been wrong in the past, obviously. I could be wrong this time, but that's my view. And if yields surge higher, then that's going to be a natural force to kind of stop the advance of metals. They're going to advance eventually, but I think that might be an obstacle.
Jean-Philippe asked about copper. He asked if copper's topping here, and why would you want to stand in front of that? That was an explosive move. You know, there's something that I learned a long time ago with technical analysis and you know, markets in general. You know, big green bars. You know what they're usually followed by?
More green
bars. Yeah, exactly. So, you know, if you're sitting there trying to fade this big ass bar that you see right here, good freaking luck, man. I mean, you go ahead and try to fade that, because usually you see 1, 2, 3, you know, they just start compounding after one another. You know what I mean? Now, this is an example of a, you know, evening star reversal, which had 0 follow through right here. But if you get my drift, more times than not, when you have a big bar that looks like that, you ain't going to want to stand in front of it. And that's one of the reasons why I sit here and I look at today. And it's not just this, by the way, it's not just this. I'm hoping for weaker data. I don't know if we're going to get it. I'm hoping for it. As I told, you know, Dominic asked in our chat room, by the way, if you guys are in the ForexAnalytix community, you know, this is what our chat room looks like. Oh, good morning, Benedict. By the way, he just posted charts, and there's Paul Franco, and everybody's posting up here right now. But Dom just asked, you know, Dominic asked, hey, anyone else thinking we rally on bad data? I think the second half of the year. Oh, you know what? I didn't read his full context, but what I meant by the second half of the year is I think the data is going to start coming in worse than expected second half of the year. That's when, you know, when things are going to happen. But the reason why I say that is because if the data is weak, then that means risk appetite will probably be strong. And so you're not going to want to fade copper. And then you look at, you know, not only the euro, which Stelios, you clearly just pointed out, but look at the Aussie. I mean, the Aussie just completed its inverted head and shoulder pattern. But do you really want to stand in front of this? I mean, this has been an absolute freight train on the way up. You know, we break 72.70 and, you know, we will trade to 74 cents really quickly. Just remember 2 weeks ago, we were below 70 cents. So, you know, this all is very strong for risk. And then on top of it, and then, you know, I want to hear what you guys have to say regarding this. You know, you look at the S&P, everybody's expecting for the S&P to, you know, break back down again. I mean, Why can't we
talk
see
38 or 43 first? So
yeah, why can't we see 4,300 before 3,800? You know, and that's the camp I'm in right now.
It looks like an impulse up. Morning, guys.
Hey, good morning, Grega. So to explain impulse and give me your thoughts on what do you think is going to happen going into today, Grega?
Well,
and how are you going to want to play it?
Yeah, I mean, we talked last week, as you remember, when we had these equal legs down on the S&P 500 round there.
I can testify to that. I testify.
Right here, equal leg.
At the bottom.
Oops.
Exactly. And back then we said that support is not important unless you see a reaction from it. So far we have seen a very nice response. And I think that this looks like an impulse on a smaller time frame from the recent lows. There are no overlaps, okay? But we still need this minor new high around 4,200. So you are now basically in a minor wave 4 right there where you have this channel. Yes. So we have to break this red trend line to make this fifth wave up. So if we can rally today to a new high of the week and see even 4,300, then I think more upside after pullbacks.
So, okay. And explain what impulsive means it means to the market. Like I'm a trader and I'm like, well, what does impulsive mean? What does that mean?
Well, impulses clearly mean what is the strongest trade. And you definitely want to be involved in these clear directional patterns rather than a choppy overlapping price action. So if you see clear price action with no overlaps, just straight move, that's an impulse. And this
would you call this move in copper impulsive?
Start of an impulsive, yes.
Yeah. And again, when it's impulsive like that, what you're implying is you don't want to stand in front of it. You'd rather go in that direction of that impulsive move. So,
but not impulsively.
Not impulsively impulsive.
You don't want an impulse trade.
No trigger pulling, hairline trigger pulling, impulsive on impulsiveness. Right.
Almost.
and Charles says impulsive is opposite of corrective. Correct. And that's exactly right. Like this is here. Let me just I'll just draw it out for you. This is impulsive. This is corrective. Right. And then flag patterns are really defined by that, right?
Yeah.
So anyway, all right. Well, great. I thank you, Grega, for the heads up. Now let me ask you this, since we got you here. What do you think? How you want to play the market today? How are you playing strong data, weak data? What do you think?
Yeah. Well, I definitely would love to see, like you said earlier, that if we get bad data, we would see move higher on the S&P 500, and that's probably then going to be just confirmation that US dollar has actually really topped there.
Okay.
Because I've heard them say that. Okay.
Keep in mind that on dollar index, we already have these 5 waves down.
Yeah.
So in my opinion, dollar index, same like here on the opposite side, is already showing us the trend has changed. And what we are seeing lately is just S&P 500 trying to also make this change with a slight delay. But if we get that another push up after important data today, this would be just another confirmation that we are really in the risk on mode, and the dollar will most likely going to see more weakness.
And I'm with you, Greg. I think the dollar index 38% retracement was a big rejection this week. And, if you're a trend follower like I am, then you're very well aware that when you get a move, okay, and you only get a 38% retracement, that usually is a continuation pattern. Once you start getting to the, beyond 50% retracement, 618, 78%, then the risks become more of a consolidative or, quite possibly a reversal. But when it's a 38% retracement, you can see a little dotted line right there. Then what it is it ends up being a continuation pattern. And I think the dollar index is going to see 100 before we see new highs. Now, I do not believe that the dollar index, I'm not necessarily, I'm undecided yet if the dollar hits new highs or not, but I don't think that the dollar index is going to new highs first before we see 100. So anyway, I'm with you on that as far as the dollar index goes. Now, let me stop really quick because we have about 6 minutes before the data comes out. Dale, you have a really great guest today. I'm actually excited to hear Professor Plum, as he's known on Twitter, just because he's been on Real Vision. I've been following him for a little bit now, for the last, I want to say, last few months.
What about next week? Do we get Colonel Mustard as well? Sorry, bad joke, but I like him.
What's that?
I like him, but it was a good joke. You have to admit.
Yeah, that is a good joke. You're funny. You're a funny dude. You know why you're so giddy? It's because you're going to see Queen in London.
Yeah, baby.
I know.
You know it's going to be raining the whole weekend.
I hope it does. No, I'm just kidding. I hope you have a great time. I'm sure it's going to be awesome. Anyway, okay, I digress. I know we have just about 5 minutes before the data comes out. I need to mention a couple of things. Guys, this is the Forex Analytics app. If we just updated our app on the app stores after, we've had the app for like 3 years maybe. And it now has it has your, a lot of different tools inside the app. So make sure you download the mobile app when you try, Forex Analytics. But you also get this included with, the trader funding program. So if you guys want to try to access larger amounts of capital, why don't you trade ours? All you got to do is pass an assessment. We have people that access live accounts every week, and they have been for the last few months. So if you want a 2-minute explainer down below, and the good thing is we give you unlimited time to qualify, to pass your assessment, excuse me. And we also give you Forex Analytics with, when you go through an assessment, because we want you to pass. We put you in our community so you can actually sit inside of our chat rooms and you can actually talk to people and see, oh, look, Blake just took 27 pips off the dollar yen from last night. Oh, great. And DK is trading this, and Kman's trading that, and Don's trading that. And then you could be in our general chat room and just talk to all of us and see what charts we're looking at. You can look at the macro room, our Flowonomics room, and talk, the macro stuff. If you're Spanish, you can be in our Spanish chat room. Look, we give you the tools to be successful. So make sure you check out the Trader Funding Program. Can't guarantee your success, but hell, we'll give you the best shot you have at it. So we have about 3 minutes before the data comes out. Any last thoughts,
Blake?
Before?
Just
Yes.
one thing to note: it is unlimited, but you have to make one trade every 30 days.
That is important. Yeah, we can't be inactive. Yeah, our broker will automatically cancel you out. So yes, thank you.
But one trade every 30 days. Come on, that's everybody.
Yeah, and by the way, it is in your assessment account. That means in your demo account, you have to make 10% with unlimited time. You just cannot lose more than 5% trailing, and 4% intraday. If you have a 4% intraday, your assessment would be over, because that means you're not adhering to very good risk rules, right?
Exactly.
Because we tailor it so we can find the best traders, not find cowboys in the market, which there are plenty of those. All right, so that would be you, Dale. All right, so hey, any last minute thoughts here? Dale, Stel, Kman, I see Grega is here. I mean, Steve's even here. So any thoughts? You got 1 minute.
Steve, say something. I miss you.
Steve hasn't been here all week. But he's here. He's here. So what do you guys say? Any last minute things?
Yeah, watch emerging markets. Dollar rand not far from important support around 1542, 44. And then dollar max, if it could break 1940, could drop another leg.
And here's the other thing. Dollar max
at 103.50.
Yeah, dollar max. You think about it. You have bad data. The dollar starts to sell off. Risk appetite gets strong. Emerging market currencies rip. I've been focused on the dollar max and dollar rand short for a while, and I think they look spectacular on weak data. So we have less than a minute. Anything else? Oh shoot, we have 20 seconds. All right, here we go. Let me pull this up, and I think we have the.
What's
S&P.
your forecast, Blake? You have 10 seconds.
The
I said 250. What do you think?
375. Sorry, 375.
Boring.
That's I know. Let me go. There's
okay.
All right.
Let's go.
Boom, and look, faster than Bloomberg.
390. Oh, that's a good guess.
Oh, look at me go. All right, so good strong dollar move, and guess what? What? Hey, how come? Okay, now stocks are reacting positively. All right, so why are stocks like
they're in that mode? It doesn't matter.
It's the average hourly earnings, guys.
Came down.
That's
it's
it.
The same, right?
Yeah,
it's in line with expectations.
Well, it was slightly worse than expected, right? So, I mean, the stock market's like, ooh, weaker wage data, blah, blah, blah.
Great to have Mike Green to react to this today.
What's that?
Great to have Michael Green with us to react to these numbers.
Yeah, and I'm gonna let you go on with him. And I just want to say thanks everybody for joining us today. I unfortunately not a huge reaction right now, but stocks are starting to catch a bid. We are starting to see the dollar come under a little bit of pressure. And I think I'm going to go buy some emerging market currencies right now. So thanks everybody for joining us.
Michael for me, please, Blake.
What?
It's not letting me promote him. Maybe you have to do it.
Let me go find
Michael Green.
What's Michael's last name?
Green.
Got him.
I don't know why it's every day I have to keep pushing it. Okay.
He is coming in right.
He's here.
There he is. All right. Hey, everybody. Thanks for joining us today. Dale, have a great interview. Michael, thanks for joining our community. I'm Blake. I'm out.
Okay. Good hunting today, guys. Michael Green, welcome to F.A.C.E.
Thank you. I appreciate it. For some reason, it says I'm not sure if you guys are doing video, but it doesn't allow.
Yeah, we can do video if you want, or we could do video, or it could just be voice. And I'm not sure if you brought anything to share on your screen, but I could bring up the different markets and share, and we could just talk.
I mean, I think you guys are hitting on kind of at least from what I've heard so far, hitting on the overall beat. The biggest thing I think that people will point to is the fact that the unemployment rate pops slightly, suggesting that there's a rounding component to it.
Okay. I want to introduce you, Michael.
What's up? Okay.
I'd like to introduce you.
Sure.
Michael Green. Michael is the chief strategist and portfolio manager at Simplify. So, Michael, I also saw a clip of you being on CNBC, and I've looked at some of your views. And the way I like to start, and I know I want to get to the markets, but it's always interesting to find out how somebody got started in this industry. What were you doing before you entered the trading business, and what was perhaps your first job in the industry? Time machine time.
Well, so I have a pretty traditional background for the industry. I went to the University of Pennsylvania Wharton School of Business for undergraduate, graduated in '92, went into management consulting. But prior to that, while I was still at Wharton, I worked for Spearleys and Kellogg and traded crude oil futures on the New York Mercantile Exchange.
Nice.
And that was I was trading those crude oil futures when Saddam Hussein invaded Kuwait. And for those of you who have seen me or met me in person, I'm actually quite a large person. And so they used to hire people basically for size in the physical pits. So intelligence had absolutely nothing to do with it.
Ever have any out trades?
What's up?
Ever have any out trades?
I couldn't hear what you said. I'm sorry.
Ever have any out trades as a floor broker?
Out
trades are thing you come in the next day, you think you have all your trades matched up during the day, and it's an I don't know. Someone doesn't know it.
Yeah, no. So everything I did was through Spearleys and Kellogg, and was actually internal to our option hedging position. So there would be no equivalent of an out trade.
Okay, so it was open outcry. A lot of guys had lost seats over it.
Right.
That's why I had a seat too, and I would hand off my order. I didn't want that risk.
Exactly.
So, okay. So Let's talk about the data now, Michael. So go ahead. You think that the market's going to cheer this?
I think it's difficult for it not to, right? I mean, the biggest concern has been a growth slowdown. We see a combination of basically all of the headline components suggesting modest improvement. If I'm just actually going through the data as we speak right now.
Okay.
The nice thing is that you return to growth in the labor force. So, we had fallen by about 400,000 last month. This month, it appears that we've largely reversed that. So we're relatively stable in this kind of 164 range, 164 million in terms of the labor force. So that's a net positive. Broadly speaking, and I write for commentary and do some of my shorter term technical analysis stuff through a firm called Tier 1 Alpha that I'm also involved with. And, what we've been highlighting there is the dynamics of market positioning. People just got really bared up and managed to put themselves into a position in which I would argue that particularly on some of the systematic strategies in the equity markets, they just got themselves too negative and the positioning was way too light. And so part of what I think we're seeing right now is if the world doesn't fall apart, this creates conditions under which people are kind of forced back into markets. Now it looks like it's tempering itself a little bit here. So it doesn't.
Okay. Well, is that contrary to your belief we're in a bear market? This is
I think we're absolutely
rally.
in a bear market. I think this is I think this is the relief rally associated with the bear market.
Okay. And do you have any kind of levels where you think it might extend to?
I actually think we could, I have to be very careful in terms of offering trading advice, but for me, there's the potential for, anywhere from a 5 to 10% rally in the SPOOs from these levels, which feels pretty significant given what we've just gone through in terms of the last week. But, this is, people forget how far we've come, right? I'm basically just describing a situation where we repeat the relief rally from March.
Okay, maybe 4,400 or so, right?
Yeah, I'm just pulling it up on my screens here, right? So that would be
okay. I'm looking at everyone's a little bit bulled up about China reopening, Michael, and copper
I have a very different view than most.
I know. Well, if you let me finish, I was going to say that you were skeptical about a China reopening. And can you tell us about that?
Yeah, sure. So look, the underlying dynamic is that China has closed the doors on its economy and has significantly reduced the ability to either leave or return to China, and has offered a narrative internally to China that is radically different than I think what we're experiencing elsewhere in the world. When you do that, you either have to have a plan to transition, the fake news effectively that you have offered to your population to a more accurate news stream, because you'll have conflicting stories coming from abroad, or you have to decide that it's not really worth it. And, I think what we've seen consistently with the COVID dynamics, the COVID zero dynamics is the continued language of, shutdowns are going to be lifted. COVID cases are falling only to be replaced immediately by, there's a spike and they're not going to reopen and they're going to lock down again, et cetera. I just don't know how they reverse it. And, the history of this is fairly straightforward. When authoritarian regimes shut, they don't reopen easily.
Okay. So basically they're closed down for business. Do you think it's a prelude to something? There is a lot of geotension over Taiwan.
I think that there is.
I'm hoping not, but what do you think?
No, I think there are a lot of concerns over Taiwan, and that seems like the logical play, right? You construct all sorts of dynamics and fantasies, but this is a very similar setup, and I've been arguing this for about 5 years. This is a very similar setup to the dynamics around the breakdown of the League of Nations in the 1930s and
Yeah.
the Molotov-Ribbentrop Protocol between Russia and Germany. This is just flipped and happening on the Eastern Front as compared to the Western Front.
Yeah, it reminds you of another period in history. A lot of parallels. What about the parallel with the 70s as far as inflation and where the Fed is going? I know people that don't think they're going to flip until the fall. And
when you say flip, you refer flipping back to easing conditions, or
yeah, at least for them to make a pivot. Do you think that they might complete their, or at least say that they're going to wait after another hike or two to see what develops? Because I don't see how they can really bring down the price of beans and corn. They can't print it. And, agricultural commodities have a different dynamic. They're not as economically sensitive as maybe copper or oil.
Well, so I think that there's a couple of components there. One is that when you have a strong, this is in part why you should be somewhat cautious about how to interpret a reasonably strong employment report. The most positive thing that I would argue that came out of this report, again, is the uptick in inflation and the increase in the labor force, because from the Fed's perspective, that will provide some help towards reducing labor pressures in the economy, which they're obviously concerned about. In terms of their ability to print beans and corn, we know that they can't do that, and they know that they can't do that. And so they have to be doing something else, which is trying to target aggregate demand by reducing employment, or at least the growth of employment, as Mester referred to yesterday. Right. I'm highly skeptical of this. And so I would just highlight that this May report doesn't yet reflect the consequences of the hiring freezes that have been announced, et cetera. The ADP report highlighted that small businesses have really been struggling. So my gut tells me that, and my gut, the analysis that you saw me talk about on CNBC, and that concerns me most is that the Fed, rather than sticking to its transitory narrative and focusing on the supply chain aspects of this, has been forced due to political realities to appear to be doing something under the threat of losing their independence.
What do you think their meeting, Paul's meeting with Biden was about? Any grand bargain? Paul probably remembers when the maestro stayed tight too long and Bush did not get reelected during that term. I mean, tightening into a midterm like that obviously isn't, going to help Biden, whose popularity is in the basement anyway.
Yeah, I think that's correct. And I would broadly argue that while the Fed is not perhaps that political, they are kind of trapped in a mode of being forced to do something. And so just like last year, they dismissed concerns about accelerating inflation and risks to supply chains not untangling in a reasonably short time period. This year, they're forced into the other side. They flipped and said they see no signs of economic slowdown. And that obviously does not match with the data sets that we're seeing. So again, anything that provides some cover is ultimately going to be interpreted bullishly by the market. The caveat to that, right, and this is one of the things that you hear me talk an awful lot about, is we're discussing fundamentals, and the fundamentals are very slow to react. They're very slow to move, whereas the technical features of the market are very mechanical in nature. And so part of what we have been struggling with in the past several months has been a significantly higher level of realized vol than it was priced into volatility contracts, i.e. options, when they were initially entered. There was a significant need to take taxable gains entering into 2022 that people delayed in 2021. And so we saw a combination of profit taking in leaders who happen to be the largest names and thereby taking down the index in a manner that the same type of activity didn't show in the smaller names in 2021. And I would broadly argue that you're seeing a lot of pressure around liquidity, and some of the liquidity indicators, things like Bitcoin, broadly suggest that this continues to be a bearish environment in aggregate. But the very mechanical nature of things like volatility targeting strategies, et cetera, simply means that if today doesn't end up being, a 3% down day, for example, you're going to continue to see strategies that had stepped to the side in the markets, things like insurance volatility targeting strategies. They're going to be forced to come back in mechanically because of their algorithms.
What are production costs, Michael, in Bitcoin?
Well, that's actually an interesting question. So depending on who you want to listen to, whether it's the Bitcoin proponents or the people that are tied into the space, most people have not updated their models for the significant increase in energy costs. Right. Our estimates are that the price of Bitcoin on average is about 23,000, and that you're approaching an inflection point in which some of the larger miners could become vulnerable as early as 25,000. A lot of these miners have also stocked up their Bitcoin rather than selling their Bitcoin. And as
you also say they have debt issues. They've leveraged some of this out too, haven't they?
Exactly. So you could actually see forced Bitcoin selling that pushes it significantly below those production cost levels.
20,000.
We think it's actually around 23,000, with some of the larger ones even being as high as 25,000.
Okay. Is this going to just turn out to be, when we look back in history, as just a part of the bubble, and Bitcoin really gets crushed over during the bear market in equities, perhaps into the fall or so?
Well, that would certainly be my expectation. I think that the degree of deception and fraud that exists within the Bitcoin universe, everything ranging from the type of discussion that we're having around production costs to the improper claims that Bitcoin relies exclusively on renewable energy. It's not a coincidence that we're seeing many of the challenges and shortages, and New York State, for example, just introduced a moratorium on Bitcoin mining in the past day. I think we're going to end up finding that there is an awful lot of fraud and misrepresentation in the space, particularly as it relates to things like stable coins on Tether.
The altcoins, I've heard people say, if you believe in,
altcoins are actually kind of fun, because for just the simplest reason, they're basically outright garbage. 99 out of 100 of them.
Yeah, they're like pink sheet stocks, right?
Yeah, and we saw that last year, right? I mean, Coinbase, which is of course now announced layoffs and rescinded offers, which is about as negative of an outcome as can occur, short of an outright significant distress condition. They listed, I believe the number is something like 4,000 tokens last year, right? That makes Jordan Belfort in his best years look like he was sitting still.
Interesting. You have a view on the dollar, Michael? Does it come into play with your analysis of the market, and whether you favor domestic or possibly looking out to some of the markets that have suffered under the weight of a strong dollar?
Well, I would again broadly point to the dynamics of, if the economic data in the US remains relatively strong versus the rest of the world, and in particular versus the Euro region, which has turned to a significant terms of trade imbalance, where Europe largely sells consumer durables and largely imports raw materials. And their capital goods sales to China are basically shutting down. I don't know if you caught the headline that Germany is no longer willing to guarantee Volkswagen's foreign direct investments into China, for example. This is the equivalent of raising insurance costs of doing business in China quite dramatically. Under both those conditions, you're creating a situation in which the two primary rivals to the US dollar, the Chinese yuan and the euro, are functionally weakened on a structural basis versus the US dollar. And
so this is just a little bear market rally bounce in euro. Do you have a different view? Just like there are different sectors in the market, commodity currencies seem to be acting pretty good. The Aussie and the Canadian, Canada. This is strong.
So again,
Canada.
a lot of this can be explained by the terms of trade dynamic.
Yeah,
commodities have obviously done extraordinarily well. I'm a little bit more concerned about the economically sensitive commodities, things like oil and the metals in particular, in part tied to the dynamics around China. Now, some of that is tempered by if China goes into Taiwan, obviously any form of military grade commodity, which would include energy and copper, for example, are going to face significant potential supply disruptions, both in terms of transport and in terms of the ultimate end demand. And ultimately,
there was a huge move yesterday in copper, Michael.
Yeah. Although that was largely tied to Shanghai news. So I'm
that they got to go out and breathe fresh air.
They actually got to go out and
I'd hang myself.
Well, that's a population reduction strategy.
Under those conditions, throw a claustrophobic person and lock them up for a while. Anyway, so what are you doing with, I admit you probably can't get specific, but there are some people that are starting to turn friendly towards the bonds. I think we're going to probably print new lows first, but do you see anything there? And is this the first time you've seen no bid in bonds during periods of risk off? It's been a long time since I've seen it.
Well, we saw that in the COVID dynamics as well, right? And it's more broadly reflective of what I would describe as liquidity conditions rather than demand conditions. Everybody kind of wants things to resolve at once, right? That's the quote unquote fun part.
Immediate gratification.
Immediate gratification, right? A crash is more fun than the slow decline that we have lived through, for example.
Right.
Bonds have, for all intents and purposes, crashed already, and the degree of rate hikes that have been embedded into the curve, we're seeing very clearly are having significant real world impacts, and that ranges in everything from housing affordability to reduced investment intentions from businesses, et cetera. Many of the in that CNBC conversation that you saw the other day, I highlighted the dynamic of a rapid increase in zombie companies. So
yes, in the Russell.
What's that?
In the Russell 3000, I believe you said 25% are zombies.
About 25%. There's about 700 companies in the Russell 3000 that are incapable of earning enough to meet their interest obligations, right? So they're either unprofitable or they're incapable of servicing their interest and therefore need to refinance. We've seen a dramatic slowdown in high yield issuance. We've seen a dramatic slowdown in investment grade issuance. Investment grade is not such a big deal, but high yield, you have to remember that these companies continue to make their interest payments. They continue to have to make their principal payments on their debt, and they continue to have to operate their businesses. And if they can't refinance their debt, then they're facing significant cash shortfalls that can ultimately result in significant distress emerging.
They actually look, HYG had, check out HYG. This is the bounce it had. Here's sovereigns, TLT based on sovereigns. No, it's a 10-year here. Look at this compared to high yield. And then corporate high grade, even better than sovereigns. But the relative strength I see so far in the bond market is the first bounce we've had out of the hole by high yield. Any reason for that?
Yep. And I think that's right. And so I would broadly actually highlight those dynamics, right? So people were super, super short HYG.
Right.
We actually have a credit hedged product that accesses HYG in a synthetic form. If you had been willing to take the counterparty risk of accessing HYG through what's referred to as a total return swap, you could pick up about 300 basis points of excess return. in this short covering rally, that number dropped
Yeah.
to 150 basis points. So in other words, the demand to
Okay.
cover shorts was huge.
Okay.
You know, a reasonable technical interpretation of that chart would be that they're all going to revisit their lows, right? You see the positive divergence.
I
on the
think
RSI.
that U.S. government debt will take out the lows. I don't know if high yield will take out the lows here. I don't know
if it'll take out the lows, but I would suggest that this looks an awful lot like what we saw back in March.
Okay.
Right. So similar
You mean
positive
this?
divergences.
This in March.
Some consolidation. This has been stronger, obviously.
Yeah. Yeah, this looks corrective and this looks impulsive to me. Did you know that R.N. Elliott was compulsive? He used to wave to everyone on the street, but his wife was corrective. So it all worked out.
Only if he did it 5 times.
What's that?
I said only if he did it 5 times.
Yeah. So, okay, there's a lot of a lot of ground we've covered, Michael. You know, after talking to you, what do I do during this time period if I'm not a trader or I don't want to buy bearish ETFs or short things? And bonds have been under pressure. Gold, if you're still a dollar bull, I would assume you probably don't.
I'm
like the gold
neutral
either.
I'm neutral on gold, right? So it has similar characteristics to things like Bitcoin, where it is both a liquidity play and a crisis play, right?
Okay.
So the dollar benefits from loss of liquidity, and broadly around the world, people are struggling to obtain access to dollars. We see this in the cross basis trades, et cetera.
Okay.
So to answer your question in terms of like, what do you do? I mean, the first thing is that I got to be extremely careful in terms of offering any form of financial advice, right? So I'm very limited in terms of what I can say. Right. I think I've been fairly clear that we are in a bear market, what I would describe as a bear market rally.
Okay.
That the Federal Reserve has misdiagnosed what is underway and believes that it is forced to do something in terms of hiking interest rates that will contribute to the shortage of and quantitative tightening is just another example of this.
Just started.
It just started.
Yeah.
You know, the really key thing to remember about something that's just starting is that it's a little bit like, you know, turning on the water in a series of bathtubs, or starting to drain the water from a series of pools, right?
Yeah.
It's a gradual process. It's not a stop start. And so again, one of the things that I think people have spent too much time worrying about is when it starts versus when does it really begin to impact. And so the slow withdrawal of liquidity, you know, if you just imagine it in terms of a series of pools that you're drawing it down from, you got to watch that first pool that'll be drained. You know, Bitcoin could very well be one of those first pools, right? Things that rely very heavily on excess liquidity.
Okay. You know, Michael, it's great to meet you and talk to you and get your views. Listeners and people that are here now watching it live can follow Michael at Prof Plum 99. Why that handle, Michael? Because you feel like you're an investigator of what's happening under the surface of financial markets. Prof Plum had the clue. Huh?
I wish that it were that serious, actually. So I mentioned that I had the relatively traditional background. I actually went from the undergraduate program and had started a PhD program. And the joke was, you know, if you think of the game of Quill, my name is Green. Mr. Green is one of the characters in there. And so as a joke, I originally adopted the Unix email handle of Prof Plum, and then when we transitioned into the internet age, Prof Plum was taken, but Prof Plum 99 was not. And so it was totally unintentional that I ever became well known within the social media sphere.
Okay, and I know something that's near and dear to your heart is a charity, the Children of Haiti. How did you get involved with that, and how can people help Here we
So
go.
my primary charity is actually an institution called Coney Island Prep, which is a school, charter school that's based in Brooklyn, New York.
Cool.
The Children of Haiti Project. This is something that my youngest son, who's headed off to the U.S. Naval Academy in a couple of weeks, became involved with, and he had asked me for some assistance in terms of helping him and his peers in raising money for a group of students that they had partnered up with in Haiti. These are children that became orphans in the aftermath of the Haiti earthquake. A school was founded for them. And the first class of graduating students from this originally middle school, and it's very similar to the pattern that was followed with Coney Island Prep. The first graduating class is now headed off to college in Canada, thanks to some of the funds that we and others have raised.
Okay. Michael Green, you're now my trading warrior brother. You
Awesome.
let me interrupt you about, I don't know, 15 times.
That's
I think
okay.
anyway, so we appreciate you being here.
Thank
Hope
you very
that,
much for inviting me.
yeah, perhaps we could do it again, and wish you all the success at Simplify and in your charity work and communicating difficult financial conditions to the public. Not easy.
Thank you very much. I appreciate that.
All
All
right,
the best to
everyone.
you and your team.
Thank you. Follow Michael at Prof Plum 99, and I hope everyone has a great weekend, recharge, and know what you're going to do next week over the weekend before the markets open. Have a plan. You could join the team in 15 minutes for the morning edge. And again, don't just count your pips, count your blessings. See everyone next week. Adios, and thanks again, Michael Green.
Thank you.